In this video, you're gonna be familiar with top 3 indicators that you can use when trading crypto. We go deep into their nitty-gritty and try to understand what exactly these indicators are supposed to show us. That way you don't even need them when analyzing charts. Of course, you can use them if you are in the earliest stage of your trading to understand their concepts better. You might not use them in the future, but you definitely need their concepts. Okay, without further ado, let's become familiar with them, and after that we go through some examples to see them from different angles so that you can get a good grasp of them. The first indicator is RSI, or Relative Strength Index. RSI is a momentum indicator, which means it measures the strength and weakness of an asset price. It does that with calculating some metrics and then draws a graph in a separate window. We call that graph an oscillator in general. Now, what's the calculation and what does it imply? It's basically a percentage of price average gain divided by price average loss in a specific period. The default period is 14. If the price of an asset closes above its open, which means we have a green candle in the candlestick charts, it's counted as a gain, and if the price closes below its open, it's counted as a loss. Simply put, in a candlestick chart for this part of our formula, RSI calculates the average percentage gain of green candles and divide that by the average percentage loss of red candles. Oh my gosh, really? Do I know to know that all those things? You might say that I don't want to know the math. Can you tell me what it means in a layman's terms? Well, it means if you have bigger gains or larger green candles in the 14 previous candles compared to loss or red candles, RSI moves up and shows the bullish or upward momentum is stronger. On the other hand, if the average of red candles in a period like 14 is bigger than the average of green candles, we have a bearish or downtrend momentum, so sellers are stronger. Now that you're familiar with the concept behind RSI, let's see how we can use them. In the RSI indicator, we have two important sections in general. Above 70, which is called overbought, and below 30, which is called oversold. When the price enters the overbought zone, it means that the bullish momentum is in its peak. In other words, buyers have been too hyped, so it's very likely that we see either a temporary reversal, or a correction, or a complete change of direction. On the other hand, in the oversold zone, selling is in its highest peak, so there is a high potential that the price reverses from there. Note that in trading we are talking about probability, so it doesn't mean that the price reverses every time that it enters those zones. There are other factors that you should consider when looking at RSI. We'll talk about that later in this video. Another way that we can use RSI is by detecting divergence. In general, divergence happens when two things go in different paths. In technical analysis, it means when the price and indicator move in the opposite direction of each other. It shows that the momentum is not on the side of the price move. In other words, the momentum of current direction is decreasing. In a bullish market, it happens when the price makes a higher high, but RSI makes a lower high. In a bearish scenario, it occurs when the price makes a lower low, but RSI does the opposite and makes a higher low. We'll see some examples later, but let's see the next indicator. Our next pick is the indicator that is the base of many other indicators. MA, or moving average, is a simple indicator that calculates the average price of a specific period. For example, the average closed price of the past 14 days. There are some types of moving average, but the most important ones used in trading are SMA, or simple moving average, and EMA, or exponential moving average. The SMA is an arithmetic average of prices, or in other words, a simple average of n previous prices. For example, the close of the past 5 days for Bitcoin has been 60k, 58k, 63k, 65k, and 62k. In this case, our simple moving average is at 61.6k. On the other hand, EMA gives weight to the recent data, so the latest prices are more important than the former ones. As a result, we can say that EMA are more sensitive to current price changes. The way that you use either of them mostly depends on how fast an asset moves. In other words, how volatile an asset is. In a volatile market such as crypto, EMAs give you sooner signals, so they work better when market is trending. Aside from which one you use, you can set them based on the different type of prices such as close, open, high and low. Although the most common setting is close. Moving averages are used in different ways, and each strategy has its own pros and cons. Crossing two moving averages is the most basic way that they are used. Basically, when a faster MA crosses a slower one, it's a sign of the direction change in price. For instance, if a moving average with the period of 50 crosses an MA with the period of 200 downward, it's a sign that the price has changed its direction from bullish to bearish. Another way that we can use moving averages is to pick a combination of them. Mostly 3 EMAs with different periods, usually 9, 21 and 50. The 9 is representative of the most recent move or wave, the 21 is the medium trend, and the 50 is longer term trend. When these 3 EMAs fan out and separate from each other, it's a sign of momentum in price and shows we are on a trend phase. On the other hand, when they are tied up and twisted, it means that we are in a consolidation phase. This is where crossing moving averages generate many false signals. In general, moving averages are more useful in a trend phase. We can also use this ribbon of 3 EMAs as a support or resistance. It means every time that the price hits the ribbon in a trend phase, it's very likely that the ribbon rejects the price. So we can open positions in the same direction of the trend. Okay, now let's see what the third indicator is. The third indicator is also a momentum indicator. Moving average convergence divergence, aka MACD or MACD, is an indicator made from 3 moving averages. MACD line is the subtraction of 2 EMAs with the period of 12 and 26. Of course, you can change the period if you like. The third moving average called signal is another EMA with the period of 9 plotted on the MACD line. Basically, these two lines are similar to what we explained on the moving average section. You can use their cross as an entry or an exit signal. For example, a buy entry can occur when the MACD crosses the signal line, and then you can exit the market when you see an opposite signal, which happens when the MACD line crosses signal line downward. Of course, again, this type of MACD usage is mostly effective when we are not in a choppy market, especially with a short range of consolidation, because that way moving averages crosses each other a lot and generate false signals, so you should better avoid crossing moving averages, especially if you are a beginner. By the way, there is a histogram on some platforms such as TradingView that shows the position of MACD and the signal lines in a histogram fashion. Basically, when MACD is above the signal, it's considered an uptrend, and the histogram is above the zero line. And when the MACD line is below signal line, it's assumed that the market is bearish, and you can see the histogram go below the zero line. The histogram might help you to see the state of a market visually better. Another way that you can use MACD is to find divergence on charts. It's exactly like what we talked about for RSI. In this case, use the MACD line as if it were RSI. Now let's see all that in some examples. Okay guys, let's see some examples so that we can get a good hang of all these 3 indicators. Let's start with RSI and MACD and examine and study this part of the chart and see how these 2 indicators have reacted and what we can find on this chart based on the graph of this chart and its relationship to the MACD and RSI. Let's start from here. Here we've got a very strong move and then the price is slowing down here, and if we look at the indicator, first of all RSI, we can see that the price is losing its momentum. The price is going down, making lower low. This is one low and this is another low. When the price makes lower low, it means that we are in a downtrend. But as you can see here, the price is making higher lows, which means that the indicator RSI is losing its momentum. If you look at this indicator, which is MACD, we can see that the price is losing momentum on MACD as well. So what happens when we see something like this? Well, we have divergence. As we talked about, we have divergence. First of all, we have a divergence here. The price is making lower low, but the indicator is making higher low. So we have a divergence here like this. Let me resize this RSI window so that we can see everything more clear. So the first thing that we can see here is this divergence here. Let's see, we can find the divergence on the MACD as well. As you can see, we can't find any divergence on MACD. This is where we have a divergence, but there is no divergence on MACD. MACD is going down exactly like our chart. So the momentum and the price is in the same direction. Why do we see something like that? Because the sensitivity of RSI is more than MACD. So sometimes you see divergence on RSI, but there is no divergence on MACD. The periods of parameters of MACD is bigger than RSI. So RSI is more sensitive, and that's why you see divergence here on RSI, but there is no divergence here on MACD. As a result, the signals that you get from RSI is more, and consequently the false signals are more. You can see here that if you want to enter the market based on RSI, we have to enter the market after the price goes above the 30 line. This is the 30 line, and if you'd open a position here, your position would have been filled here. You've had gotten the stop loss here. Normally, when you have a very sharp move before the divergence, you have to be more careful. You have to be more cautious because you already have a very strong move. This is a very strong move here, and you better look at MACD or RSI and MACD both. If you find the divergence on both of them, you can be more confident about your decision. Anyway, we have other divergence here as well. As you can see, the price makes another lower low, but the indicator continues. First of all, RSI continues making higher low, and we have this divergence on MACD as well. The MACD is making a higher low as well. So basically we have the confluence between RSI and MACD. Both of these indicators are showing one signal. We have divergence on RSI and divergence on MACD as well. So we can be more confident about this signal. And you might ask, what is the entry signal here? Well, we can use the cross of MACD and signal line as an entry signal. As you now know, when the MACD line crosses the signal line upward, we can open a buy position, and you can see that here we have this phenomenon. MACD has crossed the signal line here, and we can open a buy position on this candle here. When we open a position here, we can put our stop loss behind the last low, which is somewhere here. Let me show you with this so that you can see that visually better. As you can see, we can open a position here, and we can put our stop loss behind this low, and we have something like this. This is not a very good position because it gives us a 1-to-1 risk to reward ratio. Risk to reward ratio basically means that how much of your money you want to risk to gain a percentage of money. For example, I want to risk 1% of my money to gain 2 portions or 3 portions. In here you can see 1.32. This is your risk to reward. If you risk 1% of your money, you gain 1.32, and after subtracting the commission and something like this, you might see something like 1-to-1. And this is not the ideal trade we want to open, so that's not a very good position. You might put your stop loss behind here and your take profit twice that, somewhere like here. And as you can see, if you put your take profit here, if you want to take profit here, you can't, and the market reverses and hits your stop loss. So this is not the ideal position, but obviously you could have made some money or you could have lost some money here. But let's take a look at another example here. We have another divergence here. This is the third divergence here. We have a bigger divergence here. As you can see, the price is still making lower low, but the indicator makes higher low, and here we have both MACD and RSI pointing in the same signal. We have a better signal here. If we consider RSI as an entry point, we can enter the market after the RSI goes above 30 line, which is somewhere like here. Actually, this is a sniper entry because we enter the market in its lowest point, and after that the price goes up. But if we choose MACD for entry point, we still can enter the market, but it's not as exact as and optimized as RSI. As we saw, RSI issues sooner signals because it's more sensitive than MACD, so we might get some more stop losses, we might get more losses when using RSI, but on the other hand we can get very good sniper entries as well. So the third divergence seems to be better than the other two. We still don't know how far the price can go from here, but if we had entered the market based on RSI, we would have been in a good position now. We could enter the market here and we would be here right now, which gives us a very good risk to reward ratio. This is where we enter the market, and now we are here, which is 2.32 so far. Of course, it can still have room to grow somewhere like here, which can give us a risk to reward ratio of 3.55. You can also take profit down the road. For example, you can close half of your position when you have a 1-to-1 risk to reward ratio and let the risk grow and close it somewhere like 3 or 4x. In the meantime, you can put your stop loss on the break-even level so you won't lose any money. If the price gets back and hits your stop loss, half of your position is at break-even and you've gained the rest of half. You could have done this for the second position as well, so you could still get some profit in that position as well. Basically, this is the money management and risk management that you have to have somehow in your system. Without money management and risk management, it's very likely that you lose all your money in the end. You might gain some money, you might lose some money, but if you don't have a solid money management and risk management, you will definitely lose all your money in the end. Anyway, this is the way that you can use divergence and overbought and oversold zone for RSI and MACD. Now let's see some examples for moving averages as well. Here we have our 3 EMAs, the fastest one, which is blue here, 9 EMA, the yellow one, which is 21 EMA, and the purple one, which is an EMA with the period of 50. Okay, let's examine the behavior of these 3 EMAs on this chart. The fastest EMA, the blue one, is the most sensitive to the price, and the slowest one, which is the purple one, is the least sensitive to the movement of chart. Which means even in this fast move, in this sharp move, the price reaches the fastest moving average, the blue one, every now and then. But it's not the case for the slowest one, the purple one here. The 50 moving average doesn't have as much interaction with the price as the fastest one, the blue one. So it's less sensitive to the moves of the market. So now how we can interpret and explain the behavior of moving averages in relation to the price here. We talked about this fact that when these 3 moving averages are fan out, like here, we can expect that the price has a very good momentum, has a sharp and steep slope. It can be a start of a blasting price. After that, for example, here after that, you can see the price drops dramatically here and gets a very strong momentum. You can see this strength in the moving averages as well. They're separating from each other and the distance between them is getting wider and wider. It means that the price has a very good momentum. On the other hand, we have this section when price is consolidating for a while. This is where our moving averages are twisting and tangling up, and they generate many false signals. As you can see here, we have lots of false signals. For example, here the 3 moving averages are fanned out, but if you want to enter market based on this fact, we have to enter a market somewhere like here and open a sell position here, but the price goes up and start consolidating for a while. And maybe if we put our stop loss somewhere like here, the price hits our stop loss as well. This is where moving averages confuse and generate lots of false signals, and consequently you receive some stop losses in this area. But as you already know, we are in a probability game. You gain some, you lose some. It's very important that you gain more than you lose. If you, for example, get 2 stop losses here, you have to make up for that in this run, in this drop. For example, you need to enter the market, you have to short the market. Here, when you see these 3 moving averages are found out, and you can surf the market up to here. You can put your stop loss above here, and you can see that you have a very good risk to reward ratio. Of course, you can't hold your position in this entire run. You have to take profit down the road, but consequently you have a very good risk to reward ratio. You might get some losses here, but you have to make up for that on this bull run when you're using moving averages, because moving averages has their best performance on a trend market, and this is the trend market. This is the consolidation market where the moving averages are tangling and twisting and making and issuing lots of false signals. But this is the trend market where you can make the most of price moves. Anyway, I hope you like this video. If you found this video useful, please share and like, and of course subscribe to this channel, and definitely hit the notification bell so that you can be notified when these videos come out.